Okay, so this is for the subject capital markets, and the topic for this particular video is financial markets. So let's begin with the definition. What are financial markets? So they refer broadly to any marketplace where the trading of securities occurs, including the stock market, bond market, forex market, and derivatives market, among others. So it's essentially collectively all the other types of financial markets. Financial markets are vital to the smooth operation of capitalist economies. Okay, essentially in financial market, what you are buying or selling are financial instruments, and there are various types of financial instruments, and some of them have their own type of market. Like for the stock market, essentially just equities, shares of stocks, and then in the bond market, all they are buying or selling there are bonds, either issued by private companies or by the government. And then in Forex market, of course, foreign currencies are being exchanged, and then derivatives, options, swaps, futures contracts, things like that. Okay. So key takeaways, financial markets refer broadly to any marketplace where the trading of securities occurs. Okay, all types of securities. There are many kinds of financial markets, including but not limited to forex, money market, stock market, and bond market. These markets may include assets or securities that are either listed on regulated exchanges or else traded over the counter. Okay, some of them are regulated, especially the what do you call this? Stock market, bond market, forex. I think most of them are. Financial markets trade in all types of securities and are critical to the smooth operation of a capitalist society. Essentially, because money, financial instruments are being traded there. Okay. When financial markets fail, economic disruption, including recession and unemployment, can result. Okay. Why is it important? Essentially, in a financial system, we have, people who have the money, who have excess money, like the people who save in the bank, the depositors, and then we also have the investors who have excess money. These go to the financial intermediaries. It could be banks or non-bank financial institutions, and it could also be financial markets, right? And then those people who would need those funds would come in to the financial intermediaries to get those money and use them for, further economic activities like operating their businesses, expanding their businesses, or anything that would stimulate economic activities, because essentially that's the main purpose on why we have the financial system, so that the money being saved by other people can be used in further economic activities. Okay, so that the money would be productive, so that the funds can be used to provide more employment, to contribute more to the GDP, sales of goods and services, things like that. Okay, so that essentially is the role of financial system, and you have financial markets in a financial system as well. Okay. Understanding the financial markets play a vital role in facilitating the smooth operation of capitalist economies by allocating resources and creating liquidity for businesses and entrepreneurs. Okay, so you have your financial security, right? Those people who have no use for them would like either to sell them so that they could have the money, and then other people would have use for it, or other people who would need them would buy them. Okay, and then those people who would, in an exchange, essentially the other person is going to get the security, and then the other person is going to receive the money. And that's how funds are being exchanged in a financial market. Okay, so capitalist economy, because funds are being exchanged, or capital. Sometimes funds can also refer to capital being used by businesses, right? And then it creates liquidity because, if a person no longer wants to hold the security, the financial security, the financial instrument or the financial security instrument, then he can sell it to other people, right? That's how liquidity is being made for the financial market. The markets make it easy for buyers and sellers to trade their financial holdings, financial markets create securities products that provide a return for those who have excess funds, like interest. Okay, and then in the case of stocks, then you have dividends or the accumulation in the market price from the moment you buy it until the moment you sell it. Okay, and make these funds available to those who need additional money, the borrowers. So the financial market is also connecting the investors and the lenders with the borrowers, pretty much like financial institutions, financial intermediaries. Okay. The stock market is just one type of financial market. Financial markets are made by buying and selling numerous types of financial instruments, including equities, bonds, currencies, and derivatives. Financial markets rely heavily on informational transparency to ensure that the market set prices that are efficient and appropriate. Okay. One important thing there is the transparency and the availability of current information so that the buyers or the sellers would have, proper valuation of the securities that they are buying or selling. The market prices of securities may not be indicative of their intrinsic value because of macroeconomic forces like taxes. Some financial markets are small with little activity, and others, like the New York Stock Exchange, trade trillions of dollars of securities daily. The equities or stock market is a financial market that enables investors to buy and sell shares of publicly traded companies. Here in the Philippines, we have the PSE, Philippine Stock Exchange. The primary stock market is where new issues of stocks, called initial public offerings, are sold. And then any subsequent trading of stocks occurs in the secondary market, so between investors, where investors buy and sell securities that they already own. Okay. Types of financial markets. So stock markets, perhaps the most ubiquitous of financial markets are stock markets. Most popular, commonly well-known, most commonly heard. These are venues where companies list their shares and they are bought and sold by traders and investors. Stock markets or equities market are used by companies to raise capital via an initial public offering. Essentially, the only time the company is involved, the company and then the first holder of the security would be through the initial public offering. And then after that, the subsequent trading between the investor and another investor, that would be, through the secondary market already. Stocks may be traded on listed exchanges such as NYSE or NASDAQ. Here in the Philippines, we have the PSE. Most trading in stocks is done via regulated exchanges, although currently, instead of going through brokers or investment houses, there are online platforms provided by banks, normally by banks, which would allow individual investors to do the trade themselves. Okay, but of course there are fees. And these play an important role in the economy as both a gauge of the overall health in the economy, as well as providing capital gains and dividend income to investors, including those with retirement accounts such as IRAs and 401k plans. Okay, here in the Philippines we have PERA. I forgot what it means, but it's essentially retirement. And then of course we have the security benefits from SSS and GSIS. Typical participants in the stock market include both retail and institutional investors and traders, as well as market makers and specialists who maintain liquidity and provide two-sided markets. Financial intermediaries, banks, non-bank financial institutions. Brokers are third parties that facilitate trades between buyers and sellers, but who do not take an actual position in a stock. Okay, just, online platforms, but normally they are a financial institution providing the service. Over-the-counter markets is a decentralized market, meaning it does not have physical locations, and trading is conducted electronically, in which market participants trade securities directly between the two parties without a broker. While OTC markets may handle trading in certain stocks, smaller or riskier companies that do not meet the listing criteria of exchanges. So most stock trading is done via exchanges. Certain derivatives markets, however, are exclusively OTC. and so make up an important segment of the financial markets. Broadly speaking, OTC markets and the transactions that occur on them are far less regulated because it's just through the OTC. Less liquid and more opaque, so it's not easily tradable. Okay. Bond market. So bond is a security in which an investor loans money for a defined period at a pre-established interest rate. Sometimes there's also, what they call this, coupons included in the certificate, or there's a maturity value, or sometimes there are other conditions like redeemable, callable, things like that. Okay, but on a regular bond, so of course there's only the value, face amount, and then the interest rate, and then the period. Okay. You may think of a bond as an agreement between the lender and borrower that contains the details of the loan and its payments. Bonds are issued by corporations, normally, but it can also be issued by the government. Treasury bills. Okay. The bond market sells securities such as notes and bills issued by the U.S. Treasury, for example. The bond market is also called the debt, credit, or fixed income market. Okay. Bond is a liability, so it can also be called debt market, credit market, or fixed income market. Fixed income because the interest rate would be based on the face value of the bond. Okay, so if that's a 100,000 bond times the interest rate, let's say 10%, so that is a fixed income for that particular year. Okay, that's why it's called fixed income market, included in the fixed income market. Money market. So typically the money markets trade in products with highly liquid short-term maturities. Okay, that's why it's called money, because the security is essentially convertible immediately to cash, okay, or to money. Okay, highly liquid, ibig sabihin convertible immediately to cash. Okay, and normally what are easily convertible to cash are short-term securities. Okay, those which would mature within less than 1 year. Okay, within months, and are characterized by a high degree of safety and a relatively low return in interest because they are short-term. At the wholesale level, the money markets involve large volume trades between institutions and traders. At the retail level, they include money market mutual funds bought by individual investors and money market accounts opened by bank customers. Individuals may also invest in the money markets by buying short-term certificates of deposits, municipal notes, or treasury bills, among other examples. So normally, bonds, they do have long-term maturity, but when it comes to a point that they are going to mature within the year, then they can be sold or traded in the money market as well. Okay, same with certificate of deposits and municipal notes or treasury bills. Okay, derivative markets. A derivative is a contract between two or more parties whose value is based on an agreed upon underlying financial asset, like a security, or set of assets like an index. So, for example, let me read this first. Derivatives are secondary securities whose value is solely derived from the value of the primary security that they are linked to. In and of itself, a derivative is worth less. Rather than trading stocks directly, a derivatives market trades in futures and options contracts and other advanced financial products that derive their value from underlying instruments like bonds, commodities, currencies, interest rates, market indexes, and stocks. Okay, for example, there's company A and then company B. Company A would like to buy a machine from company B, but company B is, let's say, situated in the US. So company A, being a Philippine company, would need to purchase foreign currency, US dollars, so that he could purchase the machinery from company B. Okay, so let's say they agreed to do the sale 3 months from now. So in a way, that's their if company A chooses, he can create a derivative contract from another party or with company B. Let's say I will be purchasing the foreign currency. You know that foreign currency, the exchange rate changes every day or every trading day. And so company A, let's say he's fine with the current exchange and he doesn't want it to go higher, because if it goes higher, that means he's going to spend more peso to buy the dollars, right? So in a way, let's say I'd like to purchase the US dollars now while the exchange rate is still around 48 pesos, and I don't want it to go up to more than 50 or around 50, because that would cost me more, especially if it involves a large amount of money. Okay, although that's only 2 pesos per dollar, if let's say it's around $1 million, so that's going to be a lot of money, right? So they could create a derivative contract from that transaction, which is the purchase of the foreign exchange right now, and then let's say on the date of the sale, let's say the exchange rate did go up to 49.5 or to around 50 pesos, then company A would have saved a lot of money, and then company B is not actually affected because it's going to receive the dollars, and what they agreed upon, let's say $100,000 or $1 million, it's the same for him. It's not affected. But for company A, he benefited from that derivative contract. Okay, so that's just an example with regards to derivatives based on commodity, the machinery, and then the currencies because of the foreign exchange being used in the transaction. Okay, just to give you an example of a derivative, but there are also other types of derivatives still. Futures markets are where future contracts are listed and traded, unlike forwards which trade OTC, over the counter. Futures markets utilize standardized contract specifications, are well regulated, and utilize clearing houses to settle and confirm trades. This is just to ensure that the transaction or the contract is going to be honored. Okay, that both parties would both the parties that agreed to it would honor and pay up when the time comes. Okay, for example, in that case, company A, the exchange rate suddenly went down to 46, but since he already committed to purchase them at 48 pesos, then in a way he suffered a bit of a loss, because if he waited and exchanged the currencies when the exchange rate is at 46, then he could have saved more money. Okay, but if there is a contract, then it should be honored. Okay, suffer the losses or suffer the gain, or enjoy the gains, right? Options markets such as the Chicago Board of Options Exchange similarly list and regulate options contracts. Both futures and options exchanges may list contracts in various asset classes such as equities, fixed income securities, commodities, and so on. And now we have the Forex Market. Foreign exchange market is a market in which participants can buy, sell, hedge, and speculate on the exchange rates between currency pairs. So it's, for example, USD or Canadian, USD peso, USD JPY, USD euro, USD pound, okay, things like that. The Forex market is the most liquid market in the world because essentially those are already money, right? As cash is the most liquid of assets. The currency market handles more than $5 trillion in daily transactions, which is more than the futures and equity markets combined, because transactions between countries or companies situated in different countries. As with the OTC markets, the Forex market is also decentralized and consists of a global network of computers and brokers from around the world. The Forex market is made up of banks, commercial companies, central banks, investment management firms, hedge funds, and retail Forex brokers and investors, essentially financial institutions. Okay. Commodities markets, venues where producers and consumers meet to exchange physical commodities such as agricultural products, corn, livestock, soybeans, energy products, oil, gas, carbon credit, precious metals, gold, silver, platinum, or soft commodities such as cotton, coffee, and sugar. These are known as spot commodity markets where physical goods are exchanged for money. The bulk of trading in these commodities, however, takes place instead on derivatives markets that utilize spot commodities as the underlying asset. So they are being used as the underlying asset. Okay. Forwards, futures, and options on commodities are exchanged both OTC and on listed exchanges around the world, such as CME and ICE. Okay, so in our example earlier, the commodity there is the machinery, but it's been used for a derivative contract. Okay, so here commodities would refer to the actual product. Okay, but they can be, sold, or they can be traded through other markets, like the derivative market. Okay, and then we have the cryptocurrency markets. The past several years has seen the introduction and rise of cryptocurrencies such as Bitcoin and Ethereum, decentralized digital assets that are based on blockchain technology. Today, hundreds of cryptocurrency tokens are available and trade globally across a patchwork of independent online crypto exchanges. These exchanges host digital wallets for traders to swap one currency for another, or for fiat monies such as dollars or euros. Because the majority of crypto exchanges are centralized platforms, users are susceptible to hacks or fraud. The centralized exchanges are also available that operate without any central authority, less regulated. That's why they have, lesser fees when they, transfer money, cryptocurrency. So these exchanges allow direct peer-to-peer trading of digital currencies without the need for an actual exchange authority to facilitate the transactions. Essentially, there is no government or no central bank or no monetary board that's regulating the transactions. Futures and options trading are also available on major cryptocurrencies. Examples of financial markets. So the above sections make clear that financial markets are broad in scope and scale. To give two more concrete examples, we will consider the role of stock markets in bringing a company to IPO and the OTC derivative markets in contributing to the 2008-2009 financial crisis. We'll see. Stock market and IPOs. When a company establishes itself, it will need access capital from investors. They would need money or funds. As the company grows, it often finds itself in need of access to much larger amounts of capital that it can get from ongoing operations or a traditional bank loan. Firms can raise this size of capital by selling shares, equity, to the public through an initial public offering, IPO. This changes the status of the company from a private firm whose shares are held by a few shareholders to a publicly traded company whose shares will be subsequently held by numerous members of the general public. The IPO also offers early investors in the company an opportunity to cash out part of their stake. Okay? That's only in IPO, often reaping very handsome rewards in the process. Initially, the price of the IPO is usually set by the underwriters through their pre-marketing process. Okay? Underwriters, investment houses, brokers, financial institutions pa rin. Once the company shares are listed on a stock exchange and trading in it commences, the price of these shares will fluctuate as investors and traders assess and reassess their intrinsic value and the supply and demand for those shares at any moment in time. Okay? OTC derivatives naman and the 2008 financial crisis, MBS and CDOs, ito yun, credit default options or the credit default, some sort of insurance. Okay? While the 2008-2009 financial crisis was caused and made worse by several factors, one factor that has been widely identified is the market for mortgage-backed securities, and the mortgage there are the houses, right? These are a type of OTC derivatives where cash flows from individual mortgages are bundled, sliced up, and sold to investors. The crisis was the result of a sequence of events, as we know from the documentary, and then each with its own trigger and culminating in the near collapse of the banking system. It has been argued that the seeds of the crisis were sown as far back as the 1970s, with the CDA, which required banks to loosen their credit requirements for lower-income consumers, creating a market for subprime mortgages. Okay, it did happen, but of course, they should have been careful through the years, right? They could have revised the rules, the regulations by that point. The amount of subprime mortgage debt, which was guaranteed by Freddie Mac and Fannie Mae, continued to expand in the early 2000s when the Federal Reserve Board began to cut interest rates drastically to avoid a recession. The combination of loose credit requirements and cheap money spurred a housing boom, which drove speculation, pushing up housing prices and creating a real estate bubble. Okay, so essentially it was the regulation, the first reason. In the meantime, the investment banks, looking for easy profits in the wake of the dot-com bust and the 2001 recession, created a type of MBS called collateralized debt obligations, okay, from the mortgages purchased on the secondary market. Because subprime mortgages were bundled with prime mortgages, there was no way for investors to understand the risk associated with the product. It's somehow a portfolio. Some are risky, some are not, but majority of it are risky. Okay? When the market for CDOs began to heat up, the housing bubble that has been building for several years had finally burst. As housing prices fell, subprime borrowers began to default on loans that were more than their homes, accelerating the decline in prices. When investors realized the MBS and CDOs were worthless due to the toxic debt they represented, they attempted to unload the obligations. However, there was no market for the CDOs because, everyone has been affected already. The subsequent cascade of subprime lender failures created liquidity contagion that reached the upper tiers of the banking system. Two major investment banks, Lehman Brothers and Bear Stearns, collapsed under the weight of their exposure to subprime debt, and more than 450 banks failed over the next 5 years. Several of the major banks were on the brink of failure and were rescued by a taxpayer-funded bailout because they were considered too big to fail. Okay. Frequently asked questions, different types of financial markets. So we have the stock market, bond market, forex, commodities, real estate, among several others. Okay. Financial markets can be broken down into capital markets, money market, primary and secondary, and then you have listed versus OTC market. How do financial markets work? Despite covering many different asset classes and having various structures and regulations, all financial markets work essentially by bringing together buyers and sellers in some asset or contract and allowing them to trade with one another. Okay. Main function of financial markets. Most fundamental function is to allow for the efficient allocation of capital and assets in a financial economy. Those who don't need them, who won't be using them, put them in the market or through the financial institutions, financial intermediaries, where those who can use them for business, for economic transactions can get them. Okay. By allowing a free market for the flow of capital, financial obligations, and money, the financial markets make the global economy run more smoothly while also allowing investors to participate in capital gains over time. Okay. Why are financial markets important? Without them, capital could not be allocated efficiently, and economic activities such as commerce and trade, investment, and growth opportunities would be greatly diminished. Who are the main participants? So we have investors, the capital comes from them, and then we have speculators who look to various asset classes to make their rational bets on future prices. We have hedgers, use derivatives markets to mitigate various risks, and arbitrators seek to take advantage of mispricings and anomalies observed across various markets. Brokers often act as mediators that bring buyers and sellers together, earning a commission or fee for their services. Okay, so that's it for this one. We've discussed the financial market and the different types of financial markets and why they are important, of course. Alright, so that's it for this one. Thanks and bye.